So markets are back to all-time highs. We survived the Great Recession of March to May.
Well,
And
let me tell you this. Let me tell you this. This was probably um, a very, I would say, interesting. It's going to be an interesting environment that's going to go down in history here as to what happened and how we come out of this. We're not completely through it yet, but it's certainly going to be something that we will talk about in years to come. And not just because the president, or who the president is, but more importantly, it's basically, you heard Powell say this week in his testimony that this is essentially unprecedented, right? Like the way the what's been going on, the level of tariffs and stuff like this. Um, History has shown us that like tariffs were pretty much trending down since World War II. So the type of tariff impact that we've had here and the way that we're going about this is there really isn't anything for anyone to anchor themselves to in terms of how significant the impacts will be and really model this properly, right? Because at the end of the day, nobody knows exactly how this pans out, but I do think that the markets are resilient, and we're seeing that here, right? Tariffs are still in place, and we are, granted, there's been exceptions and whatnot along the way, but markets are back to all-time highs, so that's got to mean something.
yeah, and at the end of the day, there hasn't really been any significant progress on trade deals that we know of, at least. And this 90-day pause ends on July 9th. So are we just going to run through the same thing all over again? Trump pulls out another poster board with how the tariffs are going to be, and then we head back down to the lows, or what's going to happen here? I don't know if anyone actually has the answer.
I'm going to be honest with you. I think that um, from a political standpoint, right? Just a simple standpoint of politics, Trump is running out of time to do some nonsense like that again because he does not want the market i- at the lows into midterms.
Yeah, that's true. And I think the market's really just realizing that he really comes in strong and then pulls it back pretty much every single time. So I'm fully anticipating this 90-day deadline is going to come through. And I know they came out and said they're not going to extend it, but there's going to be some sort of thing. Like they're not going to just pull out those massive tariffs that were on the poster board initially. I don't think that's going to just come back after the 9th if they don't come to a trade deal with these countries. And I think the
No, yeah,
market's
exactly.
realizing that.
I think you're absolutely right with that. Now, look, the midterms aren't necessarily. I know I just said that, but they're not necessarily the driving factor in terms of like, oh, midterms are all that matters. They're still a little. They're still quite a bit away. Actually, it's just more the fact that look, when when sentiment is down, um, and it stays down, it becomes problematic. So, not to say that Trump didn't perfectly time a rebound in the market, right? Like how I'm not saying that the market wasn't forced higher if it was through reneging on statements, walking back trade deals, redealing, right? Whatever it may be. But at the end of the day, there was a lot of negative sentiment coming towards him for the economy when the market was down. And we all know that growth took somewhat of a hit, right, in Q1 of this year. But we're seeing that for the most part, growth rebounded. And I think that the reason I bring this up about midterms and emphasizing on it is you also don't want to run into a position where you don't have you create a situation where you don't have enough time to recover, right? Like if he puts the economy into a recession because of tariffs, and maybe some would argue that the economy is in a position where you can't really get a recession because deficits are fueling an economy running over capacity. So you're essentially going to get some type of elastic reset where the economy almost feels like it's going to crash, break down, but it snaps back. A good example of what I'm talking about, think of it like a bouncing ball. Like the ball falls very fast towards the ground, but it bounces back up. And that would be 2022, right? Where everyone was like, oh God, there's earnings compression, um, margin compression, earnings slowdown. the market was expecting a recession for sure. But at the end of the day, the deficit essentially bolstered the economy from actually running below potential and breaking into recession territory. You saw real GDP go down, but PCE, or basically consumption, the consumption component of GDP, never really breached and held below zero. So you had this facade of a recession coming to fruition, and it scared everyone, including the markets. But you didn't have it materialize. So I think we're almost at that point here where, you don't want to destroy sentiment too much, especially with tariffs and things that will in turn offset the deficit, right? Because you kind of need that deficit to keep the economy running. And the way that at least everyone wants it to run, the economy can run with a much lower deficit, but nobody wants that. We want our 10 to 15% years in the market, right? That's what everyone's trying to get. You cut the deficit down in half, the market's not going to go up at a 15% CAGR. So that's the situation that everyone's faced with. And I think that's why the administration was really gung-ho about balancing the budget in March. And then April came along and they were like, yeah, there's no way we're going to actually go through with this. I mean, S&P is already down 25%. You didn't even touch the deficit yet. If they balanced the budget, QQQ would have gone to like $300 at a minimum.
Yeah.
And it would have been devastating. And that's what I meant by earlier. Something like that, you balance the budget right now, you're not recovering by midterms. Even though they're a little over, they're a year plus away, you're not recovering. So that's why at the end of the day, I feel like the administration backed off the balancing plans, and they're just basically saying, you know what, screw it, Hail Mary, we're going to grow our way out of it.
Yeah.
And you know what? That seems like it is the path of least resistance right now. At the moment, that's what it seems like where they're going.
And so what does that mean for bonds? Because that was the big concern, is you just get runaway inflation if that happens.
What, you outgrow the deficit?
Yeah, well, if growth continues to get stronger and this deficit remains, isn't that just going to continue to be a weighted vest on bonds and possibly push them even lower? And then if another recession fear starts to seep back into the table, that would actually push bonds lower, as the deficit's going to have to blow out to if that recession does hit. Are we still in that same situation as we were just a few months ago with bonds?
I think you're in a position where term premium, basically, in layman's terms, this is the premium to hold a bond. This is the risk premium in bonds. Right now, it is elevated. We've seen this trade around zero, basically flat, even negative post-COVID, pretty much going into COVID. Before COVID even hit, this was negative. This is positive now, right? 50 basis points. It's more of an illusion, this number, because it's very hard to measure. It's an estimate. This is not a finite number that you can really calculate. There's different models, different estimates. All in all, what you're saying is I think, to some degree true. Bonds are not going to trade well in an environment like this, but I'm not going to say that they can't trade well in the future. I will say there's a high likelihood that the term premium remains elevated. We kind of stick in this range as long as deficits are at their current level. See, the thing about outgrowing your deficit is if you are prudent with spending on a long enough time frame, at least in America's situation. Like if we're talking about, Chile or something, it's a completely different story. Because at the end of the day, America can get financing for at a much longer run rate than any other country, even given, you give a South American country a 6 to 10% deficit for X amount of years, and they're not going to be able to borrow like America, right? So it's just a very interesting dynamic. I think that America can run this train long enough if they are prudent with spending to some degree. They can outgrow the issue. It's not that hard. The thing is during that period of growth or outgrowing, right? Or outrunning, you can call it. Bonds become somewhat tricky because this all comes back to the reason why bonds are tricky. And it's you have a high deficit in an overproducing economy. If you take the economy and you were to draw basically a line on GDP trend, we are essentially running above capacity. right? So GDP has trended to such a degree that the projections of where we should be, we are above those projections, right? We are running above capacity. And typically, when you run an economy above capacity, it's like a cup of water that's full, and you keep pouring, more stimulus on, it's going to just overflow. And if you don't have enough control on that cup that you're filling, it's not in a sink. There's not a release valve. What's going to happen is it's going to go all over the table, and that's what we call inflation. So the situation here is the Fed is very, very understanding of this, where they cannot cut rates the same way that they could in 2018, and Powell made that clear at this week's testimony or hearing that we're not in the same environment we were back in 2017, 2018. The Fed was cutting basically into the way before the pandemic hit. The economy was slowing. Rates are not even below the 2018 peak yet, and this is essentially telling you that the economy has at the moment, it won't be indefinite. At the moment, the economy has a higher neutral rate. And therefore, the Fed needs to be at a rate that is considerably higher than where they were in the past. And most people looking at this think it's a scam, think it's like, the government, the Fed is trying to play games with the government. But at the end of the day, if Powell were to bring rates back to where they were in 2018, the economy's in a position where the output gap is positive. So it's gonna really bleed into inflation a lot faster than it would have back then. And this is the situation that we're in, right? The Fed is almost landlocked to move policy based on the fiscal path. So, and to some degree, Powell is forced to do what he has to do because the fiscal policy path is at a certain trajectory. And it's not Trump's fault. It's not anyone in particular. It's not Yellen's fault, right? It's not any individual party. It's more apolitical than you think. It's just the entire congressional system has run policy like drunken sailors post-COVID, so specifically, right? And to reduce that policy, you have to make sacrifices. And this is what I put a post up like this about this earlier this week. But the Fed is at a point now where if things don't change in the next couple of years, I would give it maybe 2-3 years. What's going to happen is the Fed is going to have a very deep risk or strong risk of an effect to its independence. And this has nothing to do with Donald Trump. This has nothing to do with even the next president. This has to do with the entire body of Congress. Because what ends up happening is when 50% of your deficit is interest expenses, instead of sitting in a room and fighting with each other over what you want to spend, raise taxes, cut spending, do this, do that, right? Like, you want your benefits, they want their benefits, you got to concede, you got to find a middle ground. You, at some point, you hit an apex where you turn to each other and say, we can both get what we want if we both look at the Fed and tell them, screw off. And we're going to come to a point where if rates can't come down substantially enough or spending can't get curbed without causing inflation, right? Like the rates can't come down without causing inflation or spending can't get curbed, that the Fed is going to become going to be put in the political hot seat where instead of, you have when Powell does these Senate hearings, you have one side arguing their points on why, the Fed should maybe not should be more strict on banks, and you have the other side that's maybe more concerned about why the Fed isn't cutting rates. It's all going to become, why are you not cutting rates? And then you have a risk where Congress can cumulatively change the policy at the Fed, because the Fed at the end of the day is set up through Congress, right? So that's the risk. I think that these are the hyperscale risks. This is where this is what Bitcoin was made for, right? In situations like this, where if the Fed were to ever lose their independence, Bitcoin probably, in a year, it's probably 350, 500K type of thing.
Yeah, but we're nowhere near that yet.
No, we're nowhere near that.
That's like worst case scenario if we get there.
But the reason I kind of put this all in the pipe for you to think about and to talk about it is because at the end of the day, we're seeing the early stages of this now, right? like you're seeing Trump make subtle remarks about like, oh, we could save billions of dollars if Powell just cuts rates. Talking about like our budget, like looking at it and saying like, oh, we spend as much as we do on the military on interest expenses. So at the end of the day, they'll say like, oh, those interest expenses, they go for nothing. We're paying nothing. It's going to a void. And they'll try and rationalize this any way that they can. But at the end of the day, this is the cost of the stimulus that's been provided, right? There was X amount of stimulus over X amount of years. The cost at the current level is burdensome. So if you want to keep the debt load and not pay back the debt, you have to lower the stimulus level and rates will come down, and then you could service the debt and continue. But this is kind of like one of those things that I think in the next couple of years, we'll get closer and closer to that timeline where decisions have to be made to really make material spending cuts. Because at the end of the day, either the Fed will hold the government, Congress. This is apolitical. The Fed will hold the entirety of Congress up to standards, or the Fed will be ousted. That's how this ends down the road. So reason I bring this up is people are saying, oh, we need rate cuts, we need rate cuts, we need rate cuts. And I think like to some degree, the market's already priced in some rate cuts, right? If we just look at the Fed funds curve, right, we go out to like, let's just say 2027, December of 2027, you'll see here that we are at, all right. We're down at about 3.185% on the Fed funds going out to December of 2027. So right now the Fed's at 4.3. So there's over 100 basis points of rate cuts priced into the market over the next 2 years. What the Congress and everyone's looking for is 100 basis points of rate cuts this year.
Yeah, they want
and
ZERP
that's just
again.
not going to happen. Yeah, that's just not going to happen. So the situation, I think that the reason I bring all this up is at some point there will have to be and maybe it's the next party that comes in office that raises taxes, etc. There's going to have to be some sort of sacrifice. And I think you're in a position right now where everything I just spoke about in the last 5 minutes is on delay. It's not happening right now. So the market is in this free state of the stimulus is continuing, right? It's not ending. The stimulus is going to keep churning now. You're going to have the deficit. Like that deficit's not going from 6 to 3% in the next year. At the same time, the Fed's not going from 4 to 2% either. So but the market's okay with this, right? And I think we spoke about this in the last podcast. If you look at the market, right? You look at the Fed funds rate, or the 2-year at 3.7%. The last time the 2-year got close to 3% was 2018, and the economy is slowing. Trump was up in arms. Powell walked back the rate hike, basically went to a rate cutting regime afterward. The economy did slow down into COVID. The economy was essentially on the downslope going into COVID. It's kind of weird how that hit. People like to think, oh, COVID just came out of the blue. Boom, economy just imploded. The economy was already slowing into COVID. And the reason I bring this up is the Fed was able to basically add more, basically dampen the economy further with rates at 3% in 2018. Rates are at 3.7% now, and real GDP is chugging along, in the 1.5 to 2% range easily right now. Last quarter, we got the print this morning for quarter one. The final print was negative 0.5%, but that was all import related. Real demand is still 1.5% plus. So you look at this and say, well, if GDP is cranking out okay at these at these 1 to 2% real GDP levels, and we're at 3% here, higher than basically, if we go back on a weekly basis, we're the highest we've been since 2008 on the 2-year at this point, right? Not in the cycle, but we still are higher than where we were in the last 15 or something odd years, right? So I think that when you look at it like this, if you go back to 2018, if Powell would have brought rates up to these levels, then the economy would have gone into a hole well before COVID hit. Like we would have been into a recession before COVID hit. The economy was slowing before COVID, but there was no recession.
Yeah, and the deficit wasn't where it is today.
That's my point. And the deficit is your answer. The reason, so everyone wants the pre-2018 economy. And honestly, I think we all thought we saw the deficit rebound after COVID, and there was some chance that um, it was going to have, we were going to see some continued growth to eat away at the deficit. The idea was that growth was so strong from 21 to 22, from 20 to 21 into 22. You had that growth shock, but then we rebounded real quick. And the idea was that we can continue growing. That was a hiccup, and we could just outgrow the deficit. That's not what happened. Growth kind of stalled out to the point where or spending, I guess, kept up, right? Either way, it balances each other out. And now you have this situation where the deficit isn't really repaired. But everyone wants this environment post-COVID, or pre-COVID, sorry, where like if you look at inflation, the inflation is we're below 2018 peak on CPI. We're at 2018 levels on CPI. Fed is at Fed is at 4.3% right now. So if you look at it like, okay, another way to look at this is we haven't even touched the 2%. And we can do the PCE because this is what the Fed is obviously going to look at, right? This is much closer. We're at 2.1%. We have yet to breach 2% on PCE. We're going to get this update tomorrow. We'll see. But we have yet to breach 2%, and the Fed's at 4.3%. So we've been tightening the economy. The Fed has been somewhat restrictive, but you can argue, there's a way to argue this, that the Fed is not breaking anything, so there's no reason for them to be panicking yet. The problem with this is the Fed likes to get comfortable and not do anything for a prolonged period of time, and then something breaks. But we're not there yet. Yeah. And I think that this is the big dilemma, especially, you could argue, is the Fed really going to break something if the deficit is 6%?
Yeah, that's the big question. Like, can the market
can they? Is it possible?
So far, the market doesn't think so. Like the NASDAQ, the S&P, both closing at all-time highs. What are your thoughts on the current positioning at the moment? Like, do you think this is just going to continue to run from here, or are we going to get a pullback?
Look, I think we've literally gone on a 4-day win streak here. What are we? 4 straight green days in a row, right? Pullbacks are going to happen, but I do want to say this is very bullish. It's very bullish.
Yeah. I mean, typically, like when the market breaks out to new highs like this, historically, it just runs. It continues to run. Like, you get all the FOMO panic buying coming in. It's got about half a year worth of time that it needs to reprice. We pretty much haven't gone anywhere since the start of 2025.
Well, just remember we're getting super close to risk on. And we'll talk about that in a little bit. Yeah, we're not at risk on just yet, surprisingly. It shocked us a little too here, the way the market's been moving. But it could happen pretty soon. And I think that the situation that we have to pay attention to right now is, on a regime to regime basis, we left risk on in December. Market is up 3.3% since then. So it hasn't done significant amount of progress since December. Obviously, if you bottom shot the lows here, golden, right? You're great. Bottom shot the lows. If you tried to catch the dip and you did it, great. You're pretty much set at this point. But if you're trying to be tactical here and rotate, out of not taking the QQQ drawdown, you want to pick it up again. I think that the situation with NASDAQ is pretty simple, and it's going to go like this. As long as you're holding in the mid-vamp, you're not going to see any type of crazy sell-off, right? Because it's funny. Ever since the May 10th gap up, we've held every attempt. We looked like we were going to lose it on Monday, snap back up and go. So I think you're in this, some would call it one single time. Believe it or not, you've been single time framing since April 23rd. You haven't had one snap below mid-vamp. And we've seen moves like this persist. It's not like they can't, you've seen like little flashes and dips. A good example would be like here, right? Like October 2023, you get back above mid-vamp and you just churn out. You can't really break lows below mid-vamp and you just go. And then you get a flush. And it's important that you understand that you can flush to mid vamp, even lower vamp, and be okay. The trend's bullish. So our view on this is a lot. The reason I say that this is super bullish is you're at a juncture here where you could buy right now the Nasdaq today at 546, and you can go to 494, and it's still bullish. So you do have 9% of downside to Momo and still be in the bullish trend. But that also means that dips will be very, very digestible during this period. You're not gonna you're not facing some sort of situation where you're gonna easily manipulate liquidity into different directions, right? Like a good example of what I mean is like look at this, right? So in July of 2024, we go from 500 basically down to 420. We never flip trend, right? But we have this major slam down. There's enough cushion in here for price to absorb, hold, stay steady. You don't flip trend. Everything's somewhat calm within the chaos, and you can rebound and go up. And this is kind of what you want to see in bull markets where you have this, call it playground to basically eat drawdowns and not spook the market out too much. Because it's when you go below Momo and flip trend that typically, historically, things just start breaking. So what I mean to insinuate here is there is a good margin at this point where things won't break, and anything down on this way, especially once we flip risk on, which can happen very soon, is going to be aggressively buyable. Any dip, mid vamp, lower vamp, down to Momo even more, right? Because then Momo is the perfect dip buy opportunity if you ever get it. So if you're ever sidelined or whatnot and you see a dip down to Momo and a risk on bullish trend, your risk is essentially a trend flips. So you're right there. Like if I buy up here, right? If I buy 500 on the Qs, I have 12% drawdown just to get to Momo, and then we have to like work through Momo. So you have this volatility risk buying up at highs, and not to say that you shouldn't, because sometimes you buy the highs like here, and you just keep going. So you just have to understand that there's a good margin of cushion that you're not going to get flipped out of a trend in an environment like this, where we do eventually get that risk on pivot.
Yeah, and when it's risk on, the market tends to not have any crazy pullbacks. It's usually
That's
once
true.
we enter a slowdown regime, that's when it's starting to have some of those more intense pullbacks.
Let me clarify this. This drop here was in a bullish trend, but this actually was not in risk on. This was a risk off environment. This was a risk on environment. You could just tell. And this is not me looking at the chart. We flipped out of Nasdaq up here last summer and went into bonds for some short time. And I think it was July 2nd we flipped out, and then Nasdaq got smoked. And in this period, this was all risk off. Meanwhile, this was actually risk on the entire time. You could see the volatility just way more contained. And it comes down to just how market dynamics are, right? When volatility starts accelerating, it's a sign of panic and low liquidity. And those aren't risk on characteristics.
Yeah,
So
those happen during slowdowns, and that's why we have the slowdown. Like, yeah, like certain assets during the slowdown aren't going to perform as well as the S&P or the Nasdaq because slowdowns aren't recessions, and the S&P and Nasdaq can move higher during slowdowns. So it might feel shitty like being in some safe haven stocks during that period, but that's really what you're protecting yourself against is those random or seemingly random and hard to predict volatility spikes due to liquidity issues.
that's a good point. So we're technically still in a slowdown, right? As of the last reading, but I mean, listen, we are close, man.
Yeah.
Like some
We
some
pretty much
days I'm
just
just like,
the system just needs more confirmation. Like this move has been largely driven by the Mag 7 and it just needs a more broad conviction across the market that this is going to be a long-lasting bullish trend.
yeah. And I think, look, we got NFP next week. So next week's a shortened week, right? Because of 4th of July. And I think that possibly, depending on how we set up, maybe NFP, like if you look at where we are in the growth index, I'm pretty sure the growth index is going to even close higher tonight in tonight's rebatch on the batch update. Tonight, we're going to see growth index up again. And I think maybe by this time next week, NFP, maybe we can get some juice and finally flip it. But This is where like you might say, oh, if you have this intuition that you're going to flip risk on, why are you not acting on it? And if I told you all the times that I had this intuition and I was wrong and the system was right, you'd be like, okay, I understand. There's a reason why we wait, because if it's not bullish, if it's not risk on, meaning the growth index is not bullish, there's that risk. Now, there's always fake outs, right? We can go risk on bullet, we can go growth index bullish with risk on, and then something happens and we're back into, risk off slowdown. It's possible. But better safe than sorry in this environment. We want to make sure when we hit with 3 times leverage, we pound the table. We're in there. We're in a solid regime footing. We're going to try and time it to the best of our ability and ride the wave as long as possible. We do not want to put a position on with a good example. Here's a good example. Let's just say tomorrow I'm like, okay, NFP is going to be good. Let's just say odds are NFP is good next week, right? To some degree. It's not going to be shit, most likely, right? NFP is going to be good. Okay. That's base case. We'll just call that. I want to buy the Nasdaq ahead of this because I think by next week we're going to have a bullish growth index. We're going to be in risk on. It's going to be fine. I buy the Nasdaq today at 546. Let's just say tomorrow, throughout the session, it falls. Into the session, it's down. Over the weekend, I'm like, maybe I made a mistake. Let's just say it falls every single day next week, right? We just rose 4 days in a row. We could fall 3 days in a row into NFP, and then it drops even further. Growth index never went risk on. Or growth was never bullish trend. System never went risk on, right? Growth was never bullish in this case. System never in the risk on territory. So this was me front running the system hypothetically. Now guess what happens? NASDAQ drops maybe 40 points in this situation, or QQQ drops 40 points. What's your exit plan?
Yeah, like the
Because the
regime's not going
system,
to pull you out. You never
the
actually
regime,
flipped.
you never actually flipped, right? And this is the beauty of how we operate. So if we flip risk on, right, the orange square goes above 0, and we're in risk on growth index bullish. NASDAQ is bullish trend, we will buy. Doesn't matter. You tell me I'm buying at 550, don't care. 546, don't care. I'm buying. 3x leverage, 80% of my liquid net worth, boom, like that, long. And my criteria is very simple. 2 things will knock me out of the trade. 2 simple things. The NASDAQ going bearish trend, which we know that's quite far from doing, or the growth index going back to bearish trend. Given the growth index is probably at the more pivotal moment, the growth index will trigger us out before the NASDAQ can get down to Momo and go to bearish trend. So that's my stop out, the growth index in this scenario. So by me waiting to enter, I now have a stop in place. By me front running it, I have lost one of my key stop parameters. I am now faced with only one option. Pray to God a dip doesn't break Momo and we just keep going higher. And I don't really like to pray, so I like to just, know that I have like my parameters, and if they are broken, I'm out. This is not a YOLO situation, especially with 3 times leverage. Thank you guys so much for listening. If you have any questions, feel free to reach out to us on X at the Market Radar, or go to our website at market-radar.com.